Welcome to the Planning for Life podcast with certified financial planner professional Russell Jacobs and financial life advisor Carl Coolidge. Carl and Russell will share creative strategies and ideas for overcoming challenges in your personal and financial life. Inevitably, life happens, and we will empower you to reach your destination. Thanks for joining us. Now, on to the show.
Hello and welcome to another podcast with Carl Coolidge from Jacobs, Coolidge Company. Today we're going to talk about the biggest piece of legislation that's really come out in a while when it comes to taxation and financial services. It's called the Secure Act. It became law December 20th of 2019, which was pretty much the last thing that Congress really did before it took the break. And there's some meaty stuff in here that you as a person, whether you're a small business owner, whether you're a retiree, whether that you're going to try to get some stuff off to transfer stuff in a legacy manner. There's some changes there. So Carl's going to walk us through that Secure Act today. So Carl, let's go. What do you got, man?
Oh, sounds great. Well, the Secure Act, short acronym they did, or Setting Every Community Up for Retirement Enhancement Act, obviously a mouthful. First I want to point out, if you listen to our previous podcast, you know that we have a secure retirement plan process. So I just want to state it for the record, Matt, that we beat them to this acronym. just so everyone's aware.
Yeah.
But it's pretty, as you mentioned, pretty widespread changes, and really one of the bigger acts that's happened. I don't want to say since ERISA because that would be a little dramatic, but there are some big enhancements in here. And what I wanted to do is just touch on a handful of them that I really think affect most of Americans. Again, you can dig deeper into it. There's plenty of resources online, but I think the one that we've already gotten questions about and that most people probably notice is the age 70 and a half for required minimum distributions. And so what they did is, for anyone in 2020 or later, if you're not currently 70 and a half, or I should say didn't turn 70 and a half by the end of 2019, then they push that back to age 72. So that's a nice bonus for those clients who don't really want to take out that money prior to when they have to, because keep in mind, you get to continue to defer the tax and have that tax deferral benefit. And so this really allows it to go a year and a half longer. So not a big change, but certainly moved it back a little bit.
Well, I want to stop for a second. I want to talk to you a little bit about why advisors are thinking this is such a big change. I mean, that doesn't seem to be that long of an extension. I mean, really, a year and a half? How is that going to benefit the retirees? And how does that, or why would the Secure Act do that to benefit the government?
I think any time that people hear the ability to continue to defer taxes, they get excited. And so even though it's a year and a half, I think being able to do that, is advantageous and appealing to a lot of individuals. I'm a bit surprised that from a government standpoint, because they're hungry for tax dollars, that they did this. The second piece I'll talk about, I think, is sort of their compromise and why they did this to complement the other IRA distributions. But I was a bit surprised they moved it back to 72 because of the need for those tax dollars. But the second piece of this, to me, that sort of works hand in hand is now when someone passes away and they're not leaving the money to a spouse, so they're leaving it to children, sister, brother, boyfriend, girlfriend, whatever it may be, you had to take that money over your life expectancy or in a lump sum in year one and pay the tax either way. Mm-hmm. So that means if I left it to my son and he's 35 years old, he has to take it over his life expectancy. So it would be a very small amount every year. But what they did in the Secure Act was they changed it to where that has to be either done again in year one or over a 10-year period. And again, that doesn't sound like a big deal, but when you think of all of these required distributions that are occurring for that additional generation, that's where I think they're making up some of the tax difference that they're losing, if you will, for pushing the RMD back a year and a half. And again, that's just purely my opinion, but I think this is a way that, in some ways, this distribution on the IRAs to the next generation is good because it will clean up a lot of these situations and not have them lingering forever.
Yeah.
Because they're a little bit challenging from a ongoing maintenance standpoint, and it just simplifies people's situation, which I think a lot of people appreciate.
Well, let me interrupt there because how are these changes that you've at least talked about, these two big ones that you've talked about so far, how is that going to change your financial planning process?
Well, I think, it's going to be a bigger conversation, just making our clients aware of what's going on so they understand. And again, most impactful, in my opinion, will be the age 70 and a half moving to age 72, just because those clients who don't want to take their required distributions will be pleased that they can move it back, albeit, like we say, a year and a half, it still allows them to move it back a little bit. So with our planning, that'll affect some of our calculations. When we're using the required distribution, it'll show income later, so that may result in some additional savings needed. It may be a positive because you've got, a year and a half or 2 additional years to defer those taxes. So it'll be interesting to see as we're updating plans this year with our clients of how that impacts it.
One of the other things, and since you have studied 401ks extensively and actually do a lot of 401k work, what about this allowing the Secure Act allowing 401k plans to offer annuities?
Yeah, that I will say, I expect there to be some additional detail that comes out on that because what they're trying to do is really allow where someone can distribute from a 401k in the form of an annuity so they have that guaranteed income stream. And I won't dig into it too deeply because based on what I've read and how I'm interpreting it, I still think where my concern is how the different vendors or the various 401k providers are going to interpret that and how they make it make sense for distributions for those participants. I think it can be very positive, but it's a little more complicated than it sounds because someone's got to run those calculations. Someone's got to keep up with those assets. If they're not an insurance company provider, whose books do they end up going on? Do they employ an insurance provider? Did they outsource it to? I mean, there's a lot of little questions to me that have to be answered.
Gotcha. All right. What else in the Secure Act jumped out at you, Carl?
I would say, with the first time when you do an initial retirement plan, because one of the big pushes of the whole Secure Act is access for more Americans to be able to save dollars and not making it a big hurdle to implement a retirement plan, especially for small business owners. So previously they had where you could get a 3-year up to 50%, not to exceed $500 credit off your taxes when you started up a retirement plan. Well, now they're increasing that up to $5,000. So they're giving a lot more room to those new businesses or small businesses that want to implement a retirement plan to say, hey, we're going to give you this credit. And keep in mind, that's not a deduction, that's a full credit, which is a much bigger deal, up to the $5,000. The other thing they did was that also included simple plans where they get that credit of up to $500, which wasn't something that was an option before. And a simple is really just a very basic 401k with some other limits and changes to it. But before there was no identifying benefits to that from a tax credit standpoint. But now they're going to implement that if you do it in a format where you get automatic enrollment. So where you have participants sign up at a certain percentage level, then they'll give you this $500 benefit or tax credit.
Okay.
So those two are interesting to me. And then there's just some other fiduciary safe harbors if you have certain things in your plan, as you mentioned with the annuities. Another big change that is not as talked about to me was the 1,000-hour rule. So typically, when you have a retirement plan, you can exclude part-time employees or those who work generally less than 1,000 hours. Well, now they've changed or tweaked that rule where they either have to complete 1 year of service if they're under the 1,000 hours, or they have to have 3 consecutive years of service where they work at least 500 hours. So again, the goal of this was to provide those long-term part-time employees the ability to get into the retirement plan. And then from an employer standpoint, they don't have to do matching contributions on that piece because they have those consecutive years. And again, I suspect more details will come out on this, on how the different 401k providers will handle it, and also the third-party administrators, how they will account for it. So that was one that I thought was a big deal because it's a win for those part-time employees and a bit of a more challenge for the employer because they're going to have to add possibly some matching dollars depending on how that formula, finally plays out. Mm-hmm. So
with that, I don't know if you're just hedging your bet, Carl, or what, but you're saying, there's going to be more information to come. When is that going to happen? I mean, we're not far into January. I mean, it's been 30 days since this puppy's been out, so that's totally fine. But do you know? Have you heard hey, by June we're looking at some elaboration on this, or do you have any idea when we're going to get more information?
No, I've not received anything. I've been inundated, obviously, with the Secure Act and how it will impact things, mm-hmm. but specifically from a lot of the vendors or 401k providers we work with, not anything at this point. I just have seen these rules come in over the years. And to your point at the beginning, you mentioned it sort of came in right at the end of the year.
Yeah.
And so no one's really had time to adjust their systems or look at it. And if you know any large company, nothing happens in a quick manner. So I've not heard anything specifically because we're still working on, a lot of plans from last year that we finalized. But I suspect we'll get more data, and I've already do have some meetings set up with some of our contacts to dig into it a little deeper. So, yes, I hate to sound like, it will be a negative, but I don't think it will be. I just think everything is a process.
Sure. I mean, clarity is the key, right? Making sure that you as a person who does 401k, who actually, again, created that secure acronym before the government decided to snark it from you. But, this is something you guys have done for a long time and have a lot of experience in, and it's going to be neat to see how this develops. So we have to make sure, Carl, that we continue to update our listeners on what we find out about the Secure Act. Was there anything else that jumped out at you that you'd like to cover?
Yeah, a couple more items that were interesting to me. One, typically when you set up a retirement plan, a new retirement plan, you have to have it in place prior to the end of the year. And so there was funding that you could do in the next year, meaning before you file your corporate income tax returns, but you had to have the plan set up. Well, again, a tweak they made is saying, okay, now you can set up the plan after the year. So for example, right now you could set up a plan that's technically for last year. I think it will be effective in 2019 or taxable years after, excuse me. So let's just fast forward and say this was 2021. You didn't set up a plan in 2020, then you could still do that in 2021 prior to filing your corporate taxes. So I thought that was interesting because that's a new wrinkle, which again will add some complexity to record keeping and other items. Another provision was related to multiple employer plans, and that was again another big item, which typically a MEP for short or multiple employer plan, you had to have some sort of common interest in order to have a plan together. So let's say there was, 5 different electrician companies or electrical companies that all wanted to form a 401k plan together, and they would do that so they could have hopefully better pricing, more options, etc. Well, now they've removed that common interest option. So what that says is it should be now much easier for these multiple employer plans to get these economies of scale, lower cost to plan participants, et cetera, and they don't have to have any sort of common interest. Now, this won't really kick in until after 2020. So this will be more in a 2021, but that'll give all of these companies a year to figure that out, because that's going to be again, a very interesting item in my opinion, because, how large can that become? Do, 50 companies from different parts of the country all come together because they feel like they can get better pricing? Do mega retirement plans do this? I mean, it can create a lot of questions that, to your point earlier, I don't think have been answered yet. So,
yeah, the multiple employer plans. I was just recently at a conference, a 401k conference, and that's what everybody was talking about. They were like, "This is going to be, something that's a wonderful opportunity for business owners and for planners like you, because it's just going to provide people so many more options." All right, anything else on the Secure Act, dude?
Two final things. One on 529 plans, which I think most people know. Those are the college savings plans that allow you to be able to distribute money for or qualified higher expenses for college, technical schools, et cetera, on a tax-free basis. They are now allowing up to $10,000 of distributions over an individual's lifetime to be taken out to pay down on student loans. So we all know that student loans are a huge issue. Again, I don't know how much this will be used, but it's just interesting that they now are allowing money out of those 529s, again, up to this $10,000 cap, to be able to apply to student loans, which is obviously a huge issue in the college world these days. And then just two other points. One, medical expense deductions, were only deductible if they exceeded 10% of your adjusted gross. Now they've reduced that down to 7.5%. So again, that may or may not affect some people, but it may allow for some deductions on those high medical expenses. And there's also, lastly, a extension of a rule. So in 2017, they did allow individuals to deduct qualified tuition and expenses based on their adjusted gross income. They've just extended that now through 2020. So that's just something to be aware of if that affects you with those qualified tuition expenses, that you may want to look at just to make sure you got the deduction that was available for those. So those are the main highlights I took from it, Matt. Again, you can Google it. If you really want to get into it, there's some other items, but to me, that's what's going to apply to most people out there.
What else are you hearing? So the Secure Act did change a lot of the conversations of what's going to be happening for years to come. But let's talk about what else you're hearing from clients. Is there anything that you're saying, oh, okay, this is something that our client base and the general public should be concerned about here in 2020, just to kind of wrap up today's podcast?
Well, I think most people are just very concerned about the market. Obviously, we had a phenomenal market last year. Most people, obviously, depending on how you're invested, did quite well with their retirement accounts, with their investments, et cetera. And I think that's the biggest question we're getting right now is, what does 2020 look like? How is the market going to perform? And of course, I pull out my crystal ball and say, let's decide together. But there's, that's what everybody's concerned about, because you've been burned in the past where we've had great markets and then we have, huge downturns. And so I think a lot of what we're doing is just cautioning people to understand we had a fantastic year in 2019 in the markets. Enjoy it, appreciate it, but realize it's probably not the norm. And so we're just having those conversations to help them understand what realistic returns are based on their risk tolerance and how that fits into their financial plan. And so as long as they're meeting the goals and doing what they need to in their financial plan, that's what we're coming back to, because we are so planning focused of saying, are you still doing the things that you need to do? The market is great and it obviously helps all of the things that you are trying to accomplish, but you still need to stick to your plan in that process. And again, the other normal things of just making sure that people are following through on items, because I think we all tend to procrastinate, especially in the world we live in. People don't, wake up and think they need to get life insurance or they need to call their financial advisor typically. And so we just are continuing to be top of mind for people and get them to understand to get their planning done or finish those things that they need to deal with. Or I was talking to a client yesterday that I've been on for a year about getting their will done with their attorney, and they finally wrapped it up. And so just things like that, making sure they finish off. So again, as we say, when life happens, we don't want there to be holes in your financial plan.
Darn tootin' good advice there, Carl.
Thanks, Matt. I hadn't heard darn tootin' in a long time.
I'm trying to, interject with some, 1920s slang there every once in a while. So.
And I appreciate that. As do our listeners, I'm sure.
I hope so. All right, man. Well, if you all have any questions about the Secure Act or what you should really be looking at with, the volatility potentially in the marketplace, if you do wake up someday and you're like, oh my God, I do need to have some life insurance, or I really need to sit down with somebody who truly understands the planning process, please reach out to Russell and Carl. They are both absolutely fantastic when it comes to client meetings. They both have their own skill sets and they work very, very well together. Carl, what's the website again?
It is jacobsandcoolidge.com.
Magnificent. All right, so make sure that you go there. And if you know anybody who needs to hear this podcast, just go ahead and click that share button. It'll make it really easy for them to get this information, your information, to other people who really could truly use somebody in their corner that can help them become the best person they can be and live a great retirement. So for everybody at Jacobs Coolidge Company, this is Matt Halloran, and we'll see you on the other side of the mic very soon.
The content is developed from sources believed to be providing accurate information. The information in this material is not intended as tax or legal advice. Please consult legal or tax professionals for specific information regarding your individual situation. The opinions expressed and material provided are for general information and should not be considered a solicitation for the purchase or sale of any security. Russell C. Jacobs III, Carl B. Coolidge, James Jacobs, and William Schwartz are registered representatives of and offer securities, investment advisory, and financial planning services through MML Investor Services, LLC, member SIPC, Supervisory Office, Jacksonville, Florida. Jacobs Coolidge & Company, LLC is not a subsidiary or affiliate of MML Investor Services, LLC, or its affiliated companies.